What is leverage? Well, in today's video, I'm just going to break down exactly what leverage is, how to read it, and how to see it when it comes to trading. Let's get straight to the video. Like, subscribe. Let's go. So let's get straight into this one. So what is leverage? In trading, leverage means using borrowed funds to increase the size of a position. It gives a trader the ability to control a much larger trade with a smaller amount of their own capital. Leverage is usually shown as a ratio like 1 to 50 or 1 to 100, representing how much the total market exposure a trader can have compared to their initial investment. While leverage can boost potential profits, it can also amplify losses, which means traders can lose more than their starting balance if they're not careful. Because of this, leverage should be used strategically and with strong risk management in place. So if you have $1,000 in your account and you use 1 to 100 leverage, you can control position size of 100,000, which means 1% move in your favor will equal a $1,000 profit, doubling your money. But if it moves against you, you can also lose $1,000, wiping out your account. Leverage is actually described as a double-edged sword. Leverage ratio varies between brokers and assets types, but common examples include 1 to 10, 1 to 50, and 1 to 100. Conservative leverage is 1 to 10, often used for long-term position. Moderate leverage is 1 to 50, used by experienced day traders, and 1 to 100 leverage is considered high leverage and is used for short-term trades but carries out a significant risk. The higher the leverage ratio, the less margin you need to open a trade, but the greater the potential volatility in your account balance. So let's go through some examples and see exactly what this means. So example number 1, Lala has $1,000 in her account and she uses a 1 to 50 leverage, controlling $50,000 position on gold. Gold moves 1% in her favor. How much did Lala gain? Since she is now controlling $50,000 in position, 1% of $50,000 would be how much Lala gained. $500. Beautiful. Mike has $2,000 and uses a 1 to 10 leverage, controlling a $20,000 position on NASDAQ futures. The market moves 0.5% against him. How much did Mike lose? Well, again, it's 0.5 of 20,000 there, so that would be $100. So here we have Ava with $500 and she uses a 1 to 100 leverage, so pretty much a high leverage to control a $50,000 position on S&P 500, the futures there. The market moves 0.5% against her. How much did she lose? $250. I'm so sorry, but yeah, that's pretty much leverage. Again, very simple concept too as well to understand. It's also very important that you use leverage and understand how to actually operate leverage well. So take down these notes. Leverage ratio, the amount of borrowed money a trader can use compared to their own capital. Margin, the amount of money you must deposit to open a leverage position. Use margin, the portion of your account that is locked in an open trade. Free margin, the amount of money left in your account that is available for a new trade or to absorb losses. Margin requirement, the percentage of the total position you must provide as margin. Equity, your account real-time value, including open profits and losses. Position size, the total value of the trade you're controlling in the market. Make sure you take these as notes, and yeah,